Imagine running a manufacturing company where your revenue grows by 7.4%.
Right.
Your profit margins expand significantly, and your industrial free cash flow swells. And you do all of this without manufacturing or selling a single extra product.
Not one.
You ship the exact same number of units, literally down to the absolute digit as you did a year ago, but you make substantially more money. Welcome to Talk Tickers.
Thanks for having me back.
Today, we are executing a professional earnings call summarization deep dive into the Q3 2025 results of Ferrari, ticker symbol RACE.
And, if you are an experienced investor who is tired of those surface level summaries, you are definitely in the right place today.
Exactly. We have a lot of source material to get through, and our mission for this deep dive is to unpack how a company operating in, honestly, the most capital-intensive sector on Earth has managed to perfect the absolute holy grail of luxury brand management.
Right, which is monetizing scarcity.
Yeah, exactly. Monetizing scarcity. But before we get into the mechanical depth of the numbers, we need to set the stage. Because to understand the magnitude of this quarter's performance, you really have to strip away the traditional metrics that we use to evaluate automakers.
Yeah, you really do. Evaluating Ferrari alongside legacy automotive original equipment manufacturers, or OEMs, is just a fundamental mispricing of the asset.
Right, because the broader luxury auto sector is currently, it's suffocating.
It's completely choking. Premium OEMs are drowning in forced capital expenditure costs tied to their EV transitions, and they are battling severe systemic demand weakness in China, which, China has historically been the growth engine for global luxury.
Right, and you add the unpredictable volatility of global import tariffs to that mix, and you have a highly toxic environment for literally any company relying on volume to drive revenue.
Exactly. But Ferrari is completely insulated from this cycle because they don't sell transportation.
No.
They sell access to a highly curated, ultra-exclusive club. Demand operates on the principles of Veblen goods here.
Which means the demand actually hardens and increases as the price goes up. It defies standard economics.
It really does.
Yeah.
And that insulation is exactly what investors were desperately looking for this quarter.
Yeah, the sentiment stepping into this analysis is, I'd describe it as constructively relieved. Bullish but disciplined,
Right, because the stock caught a modest 1.88% bump on the day the numbers dropped.
Which is nice, but we have to look at that slight bump in the shadow of a genuinely brutal October.
Oh, absolutely brutal. Just weeks prior, shares dumped over 16% following a capital markets day that just left Wall Street highly skeptical of their 2030 targets.
Yeah, so these Q3 results were less about taking a victory lap and entirely about stopping the bleeding,
Yeah.
Proving to institutional holders that the underlying financial machinery still works flawlessly.
Let's jump into that machinery. The results snapshot.
Let's do it. So starting with the top line, it hit 1,766 million euros.
Right.
That is a 7.4% year-over-year expansion, or 9.3% if you adjust for currency fluctuations.
And that comfortably cleared the U.S. consensus estimates of $1.94 billion. They landed at $2.07 billion.
A solid beat. But the bottom line demonstrates where the operational leverage of this model truly accelerates.
Yeah, GAAP diluted earnings per share came in at €2.14, which is up from €2.08 a year ago.
And on the U.S. tracking services, EPS reported at $2.50 against a $2.35 consensus.
So that's a highly definitive 6.4% bottom line beat.
Exactly. But the profitability is completely anchored by the margins. We have to talk about these margins.
The margins are insane. EBITDA landed at €670 million.
Which is a 37.9% margin.
Yeah. And EBIT hit €503 million, translating to a 28.4% margin.
Just to put a 37.9% EBITDA margin into perspective for you, legacy automakers celebrate when they manage to scrape together a 10% margin.
Right, like pop the champagne for 10%.
Exactly. Ferrari is printing software as a service level margins on physical heavy machinery.
And it translates into robust liquidity. Industrial free cash flow came in at €365 million. Net profit at €382 million.
But this brings us back to the linchpin data point of the entire quarter. The top line grew over 7%, margins expanded, But physical shipments were dead flat at exactly 3,401 units.
It's incredible. It mathematically proves the growth algorithm relies entirely on price realization and product mix.
It's completely detached from volume.
Completely. Flat volume with rising revenue is the ultimate signal of pricing power. It shows they are not clearing inventory off a lot with heavy incentives.
Right.
They are meticulously managing a multi-year waiting list and just extracting more value from every single slot on the assembly line.
Okay, but I have to push back here. I have to challenge the durability of that concept for the listener.
Go for it.
If a company is generating more revenue from the exact same number of cars, we have to ask, is this pure, unadulterated pricing power?
Meaning they're just slapping a higher premium on the badge year after year.
Exactly. Or is the product mix masking a structural ceiling? Like, are they substituting cheaper models for multi-million-dollar hypercars because they literally cannot find more buyers to expand the base?
That's a fair question, but the mechanics of their product pipeline totally refute the idea of a volume ceiling.
How so?
The internal philosophy driving this growth is that true pricing power is not achieved by simply raising the MSRP on an aging model.
Right, because that strategy destroys brand equity very quickly.
Exactly.
Yeah.
True pricing power requires the relentless engineering of richer, more innovative products. The value proposition to the buyer has to genuinely increase.
Okay, so if you look at the deliveries driving this quarter, they were heavily weighted toward highly complex, higher margin vehicles.
Yes, exactly. The 296 GTS, the Purosangue, which is the V12 four-door, the 12 family, and the Roma Spider.
We are also seeing a highly intentional churning of the lineup to force that product mix higher, right?
Oh, absolutely. The Daytona SP3 and the SF90 Spider are currently in their phase-out windows.
And the 296 TTB is approaching the end of its life cycle, too.
Right, while simultaneously the SF90XX is ramping up its contribution.
So by constantly retiring models, they create immediate artificial scarcity.
Exactly. If you want a specific silhouette or engine configuration, your window to acquire it is rapidly closing.
Which creates urgency, and that urgency completely eliminates the need to discount.
Yes, but the base price of these new, richer models is only the foundation of the margin expansion.
The real accelerator is the monetization of personalization.
Yes, the bespoke options, high-end bespoke options like exposed carbon fiber aero kits, historic paint colors, customized interior materials.
It's massive. These personalizations now account for roughly 20% of total revenue from cars and spare parts.
Think about that. 1 out of every $5 generated is derived entirely from customized extras.
And the unit economics of that personalization are just staggering.
They really are.
When a buyer pays $50,000 for a custom paint-to-sample color, the cost of the actual paint and labor is relatively negligible compared to the premium charge.
Oh, absolutely negligible. That $50,000 flows almost entirely unobstructed right to the bottom line.
It's the core mechanism allowing a heavy industrial manufacturer to achieve that nearly 38% EBITDA margin.
And recognizing this, management's operational strategy is shifting to capture even more of this bespoke revenue by just removing friction from the purchasing process.
Right, by opening the new tailor-made studios.
Exactly. They are opening new studios in Japan and on the U.S. West Coast.
Because previously, a client might have had to fly all the way to Maranello, Italy, to sit down with the designer and spec out a highly customized vehicle.
Right. But by placing these dedicated customization studios directly in their most lucrative geographic hubs, like Beverly Hills or Tokyo, they integrate the spending process into the client's everyday environment.
Which significantly increases the take rate of those ultra-expensive, high-margin options.
It really does.
But, there is an interesting discrepancy in the numbers regarding this personalization trend that we need to point out.
The target versus actuals.
Yeah. Personalization hit 20% of revenue this quarter, which drove the top-line beat. Yet, the long-term internal financial modeling assumes a baseline penetration rate of only 19%.
Right.
This raises a critical question for your models. Are we observing peak personalization right now?
That's the big debate.
Is there a natural asymptote to how much margin can be squeezed out of carbon fiber cup holders and specialized leather before the value proposition just breaks down, even for a billionaire?
That's a great point. And the divergence between the 20% actuals and the 19% modeled baseline really reveals two underlying realities about management's thinking.
Okay, what's the first one?
First, it demonstrates a calculated conservatism in their forward guidance. Modeling slightly below current performance provides a nice cushion against macroeconomic shocks.
Which is smart. Under-promise, over-deliver. What's the second reality?
Second, it acknowledges that physical personalization does have a ceiling.
Right.
Eventually, the bespoke options begin to cost more than the underlying chassis, and the perceived value evaporates.
Yeah, you can only put so much carbon fiber on a steering wheel.
Exactly. However, the definition of personalization is evolving. As the product line transitions to incorporate more complex hybrid and electric architectures, personalization will shift from visual elements to experiential and digital elements.
Oh, that's fascinating. You are suggesting the future of customization is charging premiums for bespoke electronic interfaces, customized driving dynamics software, or unique synthetic acoustic profiles.
Precisely. The canvas for personalization expands into the digital realm.
So that allows them to maintain that 20% revenue share without running out of physical space on the car to put carbon fiber.
Right. And that digital expansion ties directly into the most significant strategic shift revealed in this reporting period.
The profound recalibration of the powertrain pivot.
Yes. The macroeconomic reality of the electric vehicle market has violently collided with long-term capital planning across the entire auto industry.
And Ferrari is drastically altering its course. The ideological shift here is massive.
Huge.
Back in 2022, during the absolute peak of regulatory and market euphoria surrounding EVs, the stated goal was that by 2030, the vehicle lineup would be 20% internal combustion engine IC, 40% hybrid, and 40% fully electric.
Right. That was the required orthodoxy at the time to appease institutional ESG mandates and aggressive government timelines.
But the new 2025 reality completely dismantles that framework. The revised 2030 target is 40% ICE, 40% hybrid, and only 20% EV.
The electric vehicle target was literally chopped in half.
While the commitment to the traditional internal combustion engine was doubled,
because electrification is now being strategically treated as an addition to the lineup, not a forced transition away from the brand's heritage.
which makes sense because the broader market adoption of EVs has completely stalled, particularly in the ultra-luxury high-performance segment.
Right. And the clients driving the demand curve have been remarkably blunt about this.
Oh, the feedback on the call was amazing. The top-tier buyers in the US, Korea, China, and Italy regarding the initial concepts for the Ferrari Elettrica, their first full EV.
They are terrified the vehicles will be heavy as elephants and fundamentally lack the joy of driving.
Heavy as elephants. I love that quote. Because weight is the existential enemy of a hypercar.
It absolutely is.
Yeah.
Battery packs add thousands of pounds to a chassis. That destroys cornering speed, and the visceral engagement that justifies a $500,000 price tag in the first place.
So what's management's solution? The engineering solution to this elephant problem relies entirely on active electronics.
Yes. Massive investments are being directed into active electronic systems designed to digitally transform the heavy elephant into an agile horse.
Including implementing simulated paddle shifts to artificially recreate the physical mechanical jolt of an internal combustion transmission.
It really highlights the incredible engineering tightrope required to navigate this era.
Right. A fully electric vehicle must be produced to satisfy specific regulatory markets and capture a niche segment of ultra-wealthy early adopters.
But the vehicle must be engineered to actively hide the fact that it is an EV.
It's remarkably similar to the ultra-high-end mechanical Swiss watch industry attempting to build smartwatches.
Well, that's a perfect analogy.
They take a meticulously crafted, heritage-rich titanium case and shove a digital screen inside it. It attempts to blend centuries of mechanical soul with modern tech.
But it often results in a compromised product that alienates the traditionalists without really satisfying the tech enthusiasts.
Exactly. And Ferrari is deploying billions in capital to avoid falling into that exact trap.
And the physical manifestation of avoiding that trap is the new e-building in Maranello.
Right. This new manufacturing facility.
It functions as the ultimate corporate insurance policy because it is designed with absolute flexibility.
Meaning the exact same assembly line can build internal combustion engines, complex hybrid powertrains, and fully electric vehicles.
Exactly. That modularity is the key to their survival.
While legacy OEMs are currently taking massive multi-billion-dollar write-downs on dedicated EV battery plants that are just sitting idle because the consumer demand never materialized.
Right. But Ferrari is not forced into making a blind, unhedged bet on 2030 government mandates.
If the regulatory environment forces EV adoption, they turn the dial and increase EV output.
But if, as the current data proves, Billionaires still want to buy roaring V12 engines. They simply turn the dial back to ICE.
They are letting verified cash-in-hand client demand dictate production. They are completely bypassing the forced technological transition that is destroying their peers.
And that manufacturing agility secures the forward-looking margins and provides the foundation for their highly robust financial guidance.
Which brings us to the forward outlook. Management firmly reiterated the upgraded full-year 2025 framework.
Right, calling for total revenue greater than or equal to 7.1 billion euros and EBITDA greater than or equal to 2.72 billion euros.
However, the fourth quarter outlook requires immediate clarification.
Yes, it does.
Because a casual observer scanning the data might see the projected drop in Q4 deliveries and just assume demand is cracking.
Which is not the case at all. The lower volume projected for the fourth quarter is entirely structural.
It is the direct result of a massive model changeover phase.
Exactly. The SF90 and the Roma lines are rotating out, while production ramps up for the new 849 Testarossa family, the F80 and the 12-cylinder.
And retooling an assembly line for a new hypercar is a highly complex physical process. You do not simply flip a switch and start building a different vehicle.
Right. It requires significant downtime to recalibrate robotics, retrain specialized labor, and execute meticulous quality control testing on the new components.
So that frictional downtime naturally depresses physical shipment numbers for a quarter or two.
Yeah. And alongside those suppressed Q4 deliveries, cost drivers are actively accelerating.
Right. There is higher anticipated SG&A selling, general and administrative expenses, and a significant step up in R&D costs.
And the most prominent line item driving this is a seasonal spike in Formula One racing expenses.
This blew my mind. The F1 budget is jumping from $135 million to $215 million.
Yeah. An $80 million increase in a single quarter for a racing program is substantial.
What's driving that?
This surge is attributed to higher fuel costs and expansive changes in the scope of the racing development.
It serves as a stark reminder that the Formula One team is not just a legacy marketing expense.
No, not at all. It functions as a highly capitalized applied R&D laboratory where hybrid and aerodynamic technologies are stress tested before trickling down to the consumer vehicles.
Wow. Even despite the Q4 retooling headwinds and the escalating R&D costs, the underlying cash generation of the business is so violent that we have to examine their capital allocation strategy.
Specifically, the execution of the €2 billion share buyback program.
Right. It was announced that this entire €2 billion program will be completed by the end of 2025.
Completing a buyback of that magnitude a full year ahead of the original schedule is the most aggressive corporate finance signal transmitted this quarter.
You really have to analyze the boardroom psychology driving this acceleration.
Yeah, think back to the October Capital Markets Day. The 2030 vision was laid out, projecting €9 billion in revenue and a 40% EBITDA margin.
And the market violently rejected it. They viewed the targets as unacceptably conservative for an asset trading at a luxury multiple.
Right. The subsequent 16% drop in the stock price opened a massive credibility gap between the C-suite and institutional investors.
And bridging a credibility gap requires more than forward-looking promises on an earnings call.
Exactly. By using their bulletproof balance sheet to aggressively retire their own equity, management is establishing a hard floor under the stock.
Accelerating the buyback by 12 months is the ultimate statement of intrinsic value.
The C-suite is effectively telling the market, if you believe our 2030 targets demonstrate weakness and you want to liquidate your position at these levels, we will gladly use our cash to take every single share off your hands.
It is a textbook defense mechanism, and this brings us to the broader investor context.
Right.
Because the juxtaposition between this underlying fundamental strength and the way the market and options traders are actually pricing the risk provides the landscape for potential alpha.
To really contextualize the options market mispricing, we have to look at the volatility leading into this print.
The stock was down roughly 12.5% over the trailing month, a drawdown entirely engineered by the fallout from that October 9th Capital Markets Day.
Institutional money was terrified that the conservative 2030 targets were a veiled admission of structural demand weakness.
And that institutional terror manifested vividly in the options pricing.
Oh, vividly. Going into the Q3 results, the options market had priced in a massive implied move of plus or minus 7.4%.
Implied volatility was severely elevated.
Traders were treating this earnings event as a highly binary catalyst.
Meaning either the underlying model would show actual cracks and the stock would gap down another 7%, or the fears would be disproven and it would rip higher by 7%.
Right. But the reality was a highly muted realized move of just plus 1.9%.
The options sellers extracted massive premiums from the options buyers.
The implied volatility completely crushed post-print, as the realized volatility was practically non-existent.
So the market is currently treating this asset as a long-term show-me story, while simultaneously giving it a passing grade for the immediate quarter.
Yeah, the 1.9% bump, it translates to the market saying, the quarter was clean, the accelerated buyback protects the downside, so we won't sell off.
But the skepticism regarding the 2030 vision remains, so we will not aggressively bid it up either.
Exactly. It is a state of cautious, wait-and-see equilibrium.
That equilibrium, however, severely underprices the company's macroeconomic agility.
It really does. Look at their handling of the recent U.S. import tariff threats. It's a masterclass in dynamic pricing and brand preservation.
The entire luxury sector has been paralyzed by the threat of massive import tariffs on European goods entering the U.S. market.
Because the math on tariffs is devastating for luxury goods.
Right. If a 25% tariff is applied to a $400,000 vehicle, the consumer is instantly hit with a $100,000 price increase.
And that magnitude of sudden friction destroys demand, even for high net worth individuals.
So, initially, their internal modeling prepared for the worst-case scenario.
Yes. A strategy was drafted to implement U.S. price hikes of up to 10% to partially offset the feared 25% tariff.
Pushing a significant portion of the geopolitical cost directly onto the buyer.
But when the geopolitical dust settled, the tariff landed at 15%, significantly lower than the 25% fear.
Now, a lesser brand, desperate for margin expansion, would have maintained the planned 10% price hike and quietly pocketed the difference as pure profit.
Oh, without a doubt. Instead, Ferrari demonstrated extreme commercial agility.
The planned price hike was immediately trimmed and capped at a maximum of 5% to match the reality of the 15% tariff.
That decision perfectly illustrates the difference between short-term greed and long-term greed.
Right, because while the client base consists of billionaires, they are highly sophisticated consumers who instantly recognize and resent arbitrary price gouging.
Exactly. By dynamically lowering the price hike, the brand relationship is preserved.
They actively protect their long-term pricing power by refusing to abuse it for a short-term quarterly beat.
And you have to contrast this long-term greed with the current reality of their premium OEM peers.
Oh, man. Porsche, Aston Martin, and the high-end divisions of Mercedes and BMW are bleeding right now.
They are suffering massive margin contraction due to heavy discounting required to move sitting inventory.
And they are taking billions in write-downs on failed EV strategies.
Plus, they are highly exposed to the severe economic downturn in China.
Meanwhile, the order book for Ferrari remains completely full well into 2027.
If you allocate capital for a new vehicle today, you will not take physical delivery until the end of the decade.
And the demographic data coming out of China for Ferrari completely defies the regional macroeconomic collapse.
It's staggering. While luxury spending in China has cratered across almost every other sector, there is a verified surge of new, younger demographics aggressively adopting the new 12-cylindry model.
Specifically buyers under 40 years old.
Right. They are completely immune to the regional downtrend.
So when you synthesize all this data, the flat unit volume paired with relentless margin expansion,
The dynamic management of tariff shocks,
the pragmatic pivot back to internal combustion engines,
the multi-year locked order book,
and the increasing adoption by younger demographics into depressed economies.
the structural reality becomes undeniable.
This is not an automotive stock.
No, it is a luxury monopoly, mathematically constrained by its own highly engineered scarcity, operating entirely outside the traditional boom and bust auto cycle.
And that structural reality creates massive inefficiencies in how the stock is traded, which transitions us perfectly into the speculative portion of our deep dive.
My favorite part.
It is time for our Trade Ideas segment, where we explore the mechanical applications of the data we just unpacked.
Let's hear them.
But before we outline these strategies, I must explicitly state for the record, this is not financial advice.
Emphasize the not.
We are exploring market mechanics, theoretical option strategies, and macroeconomic pair trades for educational and entertainment purposes only. You must do your own due diligence. Do not execute trades based on a deep dive.
Lawyers are happy.
With the compliance lawyers satisfied, let's look at trade idea number 1. I call this the prancing horse volatility drain.
Catch you.
This is a pure option selling strategy designed to exploit the market's fundamental misunderstanding of the order book.
Okay, walk us through the mechanics.
The mechanism here is simple. The options market continually misprices the earnings volatility of this asset. Because it is categorized under consumer cyclical automotive, algorithmic pricing models assume there is always a tail risk of a massive downside revenue miss if consumer demand suddenly evaporates.
Right, which is why they priced in that massive plus or minus 7.4% move for this quarter.
Exactly. So the play is to mechanically write iron condors, or sell out of the money straddles in the weeks leading up to their quarterly prints.
And why does this work structurally?
Because a business model built on a multi-year waitlist is mathematically insulated from sudden top-line shocks. If global macroeconomic demand drops by 20% tomorrow, this company still has 3 years of contracted buyers waiting in line to take delivery.
Their revenue for the next 12 quarters is functionally locked in.
Right. Volatility traders are paying massive premiums for downside protection on a stock that simply cannot experience a sudden revenue collapse.
So you step in, sell that elevated implied volatility. The stock realizes a boring 2% move because the earnings are perfectly predictable, the options expire worthless, and you harvest that premium quarter after quarter.
It is a structurally sound arbitrage.
The strategy relies on the market's fear of a cyclical automotive downturn, perpetually overriding their comprehension of a luxury Veblen goods order book depth.
Exactly. As long as that verified waitlist extends beyond 24 months, the probability of a catastrophic earnings miss that would justify a 7% implied move is statistically microscopic.
You are essentially collecting premium by selling fire insurance on a building made entirely of concrete.
Exactly the concept. Let's move to trade idea number 2. I call this the internal combustion arbitrage.
Okay, another pair trade.
Yes. This is a directional pair trade based on the massive divergence in capital expenditure efficiency across the luxury auto space.
Break it down for us.
The strategy is to go aggressively long race and heavily short a pure play luxury EV maker.
Or short, the EV-focused proxy of a legacy European competitor who remains structurally committed to a forced 2030 electric transition.
Exactly. The rationale is rooted in the powertrain pivot we analyzed earlier. The quiet part was finally said out loud. The high-performance EV market is a commercially toxic environment.
Because the battery technology destroys the emotional driving dynamics of the brand.
And the ultra-wealthy consumer is aggressively rejecting it in favor of traditional internal combustion.
So you go long the company that just secured its profit margins for the next decade by pragmatically slicing its EV targets in half and extending the highly profitable life cycle of the V12 engine.
Right. And simultaneously, short the competitors who are trapped by their own ideological dogma. Competitors stuck pouring billions of dollars into forced EV battery plants and retooling efforts to meet a regulatory demand that the actual consumer refuses to buy.
This pair trade isolates the friction between consumer reality and government mandates.
It really does.
By going long the flexible manufacturing model, you are investing in a brand with the pricing power to simply absorb any future regulatory fines or carbon offset taxes and pass them directly to the consumer, who will happily pay the premium for a V12.
Well, by shorting the forced transition competitors, you are betting against companies that lack that pricing power. Companies that will be forced to internalize the massive losses of their failed EV investments, destroying their margins and shareholder value.
So in short, we are going long commercial agility and shorting forced capital destruction.
Perfectly summarized. We have covered immense analytical ground today, dissecting a quarter that perfectly illustrates the mechanics of absolute pricing power.
To distill the core mechanics for your models, the Q3 print definitively proved that flat volume is the ultimate driver of margin expansion when paired with extreme product curation.
Right.
The highly pragmatic delay in the electric vehicle transition demonstrates a commitment to verified consumer demand over artificial regulatory timelines.
And the acceleration of the €2 billion share buyback is a masterclass in deploying capital to aggressively defend the stock's floor valuation and repair institutional credibility.
It really is.
But as you integrate these mechanics into your broader market view, I want to leave you with a final provocative thought regarding the future of this space.
Oh, let's hear it.
We discussed the massive engineering effort required to turn the heavy electric elephant into an agile horse. Billions are being spent on active software to simulate the mechanical violence of paddle shifts and replicate the acoustic profile of an engine.
Right, the digital soul.
But what happens in 2026 when the targeted early adopters actually take delivery of these digital supercars.
Yeah, what's the real-world reaction going to be?
What happens when a buyer, sitting in a perfectly engineered, software-simulated vehicle, realizes that no matter how flawless the code is, they intrinsically miss the physical, visceral vibration of thousands of tiny explosions happening inches behind their head?
It's a huge unknown.
Will a simulated software paddle shift command the same outrageous pricing premium and hold the same astronomical residual value in the secondary markets as a genuine, naturally aspirated V12 engine?
Can you successfully digitize the soul of a mechanical asset?
Or will the physical reality always command the ultimate premium? That's what you have to model out. Thank you for joining us on Talk Tickers for this deep dive.
Thanks, everyone.
As a final reminder, this analysis is for informational and educational purposes only and does not constitute financial advice. Stay disciplined in your models, stay analytical in your assumptions, and we will see you on the next print.